They didn't do it slowly. They didn't do it politely. They didn't do it when the market was deep and liquid. They did it when the book was thin, when stops were stacked, when leverage was fat, and they hit the button. If you looked away for 1 hour, you came back to a crime scene. Silver was printing fresh highs, and then it got smashed. A $12 move that felt like somebody kicked the door in, and if you're sitting there right now thinking, okay, this is it. This is the top. The whole thing was a trap. Listen to me. What you're watching is not a moral event. It's not a market sentiment event. It's not silver is suddenly worthless in 60 minutes. This is a structure event. This is a microstructure event. This is a margin plus stops plus liquidity event. And this is the part nobody says out loud. It can also be a bank war event. A hit that does two jobs at once. It liquidates weak hands at the worst possible price. It sets up a delivery advantage for whoever can survive the chaos. Today we're going to do three things. 1. Reconstruct the hit, why the crash happened fast. 2. Explain the bank war theory without fairy tales, what would have to be true for a JPM versus Deutsche delivery nightmare to be real. 3. Give you the next 48 hours battle plan. Buy the dip or bail out, based on your risk profile, not your emotions. Let's start with the boring truth. Boring truth is what saves you. Silver has been on a historic run, and then right into the most crowded, most leveraged moment, the exchange tightens the screws. This week, the CME raised margin requirements on silver futures more than once after wild price swings. That is not a headline. That is a weapon because margin is gravity. Margin decides who gets to stay in the trade. When margin goes up, anyone who's over-leveraged has only two options: wire more cash immediately or sell. Now, no debate. No, I'll do it tomorrow. Sell or you're liquidated. And when silver is crowded on the long side, when retail is celebrating, when breakout traders just piled in, a margin hike becomes a long squeeze. Not a short squeeze, a long squeeze. The exchange doesn't need to ban you. They just make it expensive to exist. Here's what we can confirm publicly. CME performance bond notices show hikes for COMEX silver futures. For example, the notice effective after DEC 29, 2025 shows increases, e.g., SIT, increase, new initial, 25,000. Then another notice effective after DEC 31, 2025 shows a further increase, e.g., SIT, increase, new initial, 30,500. Translation: they tightened margin into year-end. They tightened margin into volatility. They tightened margin when the most people were emotionally committed, and that's why the selling is violent. Because it isn't voluntary, it's forced. Now pair margin pressure with the second ingredient. Ingredient 2, thin liquidity. Holiday week. Books closing, desks half-staffed. Liquidity is not normal, so the same amount of selling causes more damage. One shove moves the whole room. That's why you can see silver go from record highs to the low 70s fast. And this isn't internet rumor. Major outlets reported silver pulling back hard from record highs around 83 plus and dropping toward the $72 area during the margin-driven reversal. So if you're trying to emotionally process this as betrayal, stop. This is not betrayal. This is the market doing what it always does. Find the leverage, crush it, collect the liquidation. Why this feels personal, the stop-loss slaughter. Now let's talk about the part that makes you feel hunted, stops. Most people think a stop-loss is risk management. In a normal market, it can be. In a thin market, during a margin shock, stops become fuel, because once price breaks a level everyone is watching, selling triggers more selling, stops trigger, algorithms smell blood, market makers widen spreads, liquidity steps back, and the move accelerates. This is why the crash can look like a cliff, not because everyone changed their mind, because the structure turned into a domino line, and someone with size, can aim for those levels. Which brings us to the bank war angle. The bank war theory, JPM versus Deutsche. Here's the claim floating around. JPM smashed paper price, triggered stops, then forced Deutsche, new player, to deliver millions of ounces at the lower price. Sounds cinematic, sounds like a villain plot, but I'm not here to sell you cinema. I'm here to tell you what would have to be true for that to be even remotely real. Because if it is real, it matters. And if it's not real, you should not build your worldview on fan fiction. So let's break it down. Step 1. Can a large player aim at stop zones? Yes, in thin liquidity, concentrated order flow can push price through obvious levels. This doesn't require magic. It requires liquidity gaps, clustered stops, and a catalyst, margin hike, that removes natural buyers. Margin hikes remove the dip buyers who were over-leveraged. They become sellers. That creates an air pocket. In an air pocket, price falls until it hits real bids. So the hit part is plausible as structure, not conspiracy. Step 2. Can they force a specific bank to deliver? This is where people go too far. COMEX delivery is a real mechanism, but it's not a WWE cage match where we see JPM versus Deutsche on the screen in neon. What's true, silver futures are physically deliverable. Delivery flows through clearing members and warrants. Delivery month dynamics can turn violent when physical is tight. You can get a scenario where a bank ends up short delivery exposure and has to source metal, either in the warehouse system or OTC, to meet obligations. But here's what's not automatically true, that it was intentional, that it was one specific named bank as the victim, that we can confirm it in real time without delivery reports and clearing data. So to responsibly tell this story, we do it like this. We treat JPM trapped Deutsche as a hypothesis. Then we test it with observable data. The 3 million ounce number, the math. The claim says 3 million ounces. Let's translate that into COMEX language. A standard silver futures contract is 5,000 ounces. So 3,000 ounces, 5,000 tranches 600 contracts. That's not a meme number. That's a real delivery size chunk. So if someone says 3 million ounces delivered, what we'd look for is a cluster of delivery notices totaling 600 contracts across a short window, or a sudden pattern in the delivery month showing one side stopping size now. Can we see that instantly today? Not from the price chart alone. You need delivery notices, JPM daily bulletin data, and you need warehouse stock movement. Because here's the twist that makes the delivery trap story believable in spirit. Paper down, physical tight. In real squeezes, you often see disconnects, spot price prints, panic lows, physical premiums don't collapse. Warehouses show metal moving open interest behavior tells you if it was liquidation or fresh shorting. This is exactly why people keep pointing to physical truth versus paper price. And major coverage around this volatility has already emphasized the role of leverage, margin, and forced repositioning, not a sudden collapse in industrial need. So the right way to tell the bank war story is, here's the structure that can create it. Now here's the data that would confirm it. Let's go to the data checklist. The 5 data points that confirm or destroy the delivery nightmare. If you want to know whether this was just a liquidation flush or the opening move of a delivery fight, you watch 5 things. 1. Open interest behavior, March 2026 contract focus. If price crashes and open interest collapses, that's liquidation. Longs got forced out. If price crashes and open interest rises, that's fresh shorting into the drop. Someone is leaning. CME provides tools explicitly for open interest patterns and open interest change by expiration. This matters because the trap story requires someone to sell into the drop and end up short exposure that must be covered later. 2. Volume spike timing. Did volume explode exactly as key levels broke? That stops plus forced selling. 3. Warehouse stocks. Registered versus eligible registered metal is what's available for delivery, in simplified terms. Eligible is metal in the system, but not necessarily committed. If registered stocks are flat, but withdrawals spike. If metal moves out while paper price is down, that's the twist moment. That's when paper is screaming cheap while physical is quietly getting pulled. 4. Physical premiums. If spot drops but premiums stay high, it tells you physical sellers are not panicking. It tells you the crash is paper-led. 5. Delivery notices, stops, and issues. This is the actual battlefield. If you see heavy stops clustered, especially if they persist after a smash, it tells you someone is taking metal, not just trading paper. So here's the honest statement. If the 3 million ounce delivery nightmare is real, you will see it in delivery flow plus warehouse movement plus open interest behavior, not in someone's tweet. Why JPM would want this if the theory is true? Now let's talk motive. Again, hypothesis, but a coherent hypothesis. If you're a dominant player and you want physical, you want 2 things. Lower paper price, so the market thinks metal is plentiful. Forced liquidation, so weak hands dump contracts and inventory exposure. A smash does that. It creates the illusion that demand died. Then the strong hand buys into the panic. This is the oldest play in commodities. The hit isn't about profit, it's about positioning, and it's about transferring metal from nervous hands to unbreakable hands. The reason this story has traction is because the broader silver narrative has been tied to supply tightness, critical mineral framing, and intense industrial demand themes, and year-end volatility has been widely reported as structurally driven. So if a new player got caught, whether Deutsche or anyone else, the mechanism wouldn't be Hollywood. It would be thin book margin hike forced liquidation price smash through stop pockets, then aggressive stopping, physical sourcing into the chaos. That's what a real trap looks like, not a villain monologue. The real enemy. It's not the price, it's your emotions. Let's talk about what this crash is actually attacking, your emotional capital. The market can't steal your ounces, but it can steal your conviction. And if it steals your conviction, it eventually steals your position. because you sell at the bottom of the slingshot. That's why these moves happen fast. Speed is a weapon. Speed doesn't give you time to think. Speed forces you to react. So I'm going to slow it down for you. A margin-driven flush is not the same thing as a fundamental collapse. A stop cascade is not the same thing as silver is finished. A 1-hour crash is not a 10-year thesis break. Unless your thesis was, I can't handle volatility, then yes, your thesis broke, but that's not a silver thesis, that's a leverage thesis. Levels that matter? Stop staring at the red candle. Now we get tactical, because tactics calm your nervous system. Here are the levels I care about after a smash like this. Level 1, the panic low zone where price slammed into bids and bounced. That's where real money showed up, even if it's temporary. Level 2, the reclaim level, the we're back level. Usually the midpoint of the crash candle or a previous breakout area. If price can reclaim and hold, it tells you the flush was a reset, not a reversal. Level 3, the failure zone. If price rallies and gets rejected hard at the same level repeatedly, it tells you sellers remain in control. So your job is not to predict the future. Your job is to watch how price behaves around these zones, because price behavior tells you who is trapped, longs or shorts. And after a crash like this, the market loves to do the cruelest thing. It punishes longs first, then it punishes shorts second. Whipsaw is how the board gets cleared. Buy the dip or bail out, the only honest answer. Here's the truth. There is no universal answer. There are two different games being played on the same chart. Game A, the leveraged trader. If you're over-leveraged, your job is not to be brave. Your job is to survive, because the exchange just told you the rules can change overnight. Checklist A, survival mode. Reduce size until you can survive a second margin hike. Stop averaging down with borrowed money. Respect liquidation risk. If you can't sleep, your position is too big. This is not cowardice. This is math. Game B, the longer-term holder, chief physical-minded investor. If you're not leveraged and your thesis is structural supply stress, the crash becomes something else. A transfer event, a discount window, a test of patience. Checklist B, position mode. Separate paper volatility from physical reality. Watch premiums. Watch warehouse flows. Watch open interest. If physical stays tight while paper price is down, that is the tell. The Deutsche delivery nightmare, how it would play out. Let's say the trap theory is real. Here's what the movie would look like in real markets. Scene 1. The bait silver runs hard. Late longs pile in. Leverage builds. Scene 2. The catalyst. CME hikes margin. Liquidity thins. Forced selling begins. Scene 3. The push. A dominant seller hits the weak levels, triggers stop cascades. Scene 4. The hidden buy. While the chart looks like death, the strong hand is quietly accumulating exposure to delivery. Scene 5. The victim problem. A bank that's short delivery exposure has to find metal, not next month, now. And if physical is tight, sourcing metal gets expensive, even if paper is temporarily cheap. That's the nightmare. Paper says cheap. Reality says not available. So the short ends up paying in some form higher OTC premiums, tighter lease markets, collateral costs, forced unwinds, or warehouse drawdowns. Again, I'm not claiming this is definitively JPM versus Deutsche. I'm telling you the structure that makes the story plausible. And the only thing that matters is whether the data confirms delivery pressure. Why the paper smash, physical draw pattern matters. If paper price can be smashed this hard, and physical still doesn't flood the market, then the paper price is not the true clearing price, it's the liquidity price. And when liquidity price disconnects from physical reality, one thing happens eventually. Price discovery breaks upward, because the system can lie about value for a while. But it can't lie about inventory forever. That's why margin events are double-edged. They cause brutal dumps, and they create the conditions for brutal snapbacks. I'm giving you 3 regimes, not predictions. Maps. Regime 1, V-shaped snapback. What has to be true? Forced selling finishes, bids show up, sellers can't push it lower. What it looks like, sharp bounce, quick higher lows, reclaim of key levels, volatility stays high, but direction improves. Translation. The flush cleared leverage, not demand. Regime 2, dead cat bleed. What has to be true? Bounce is short covering. Only rallies get sold. Macro stays tight, dollar firm. What it looks like, bounce, then fade lower highs. Repeated rejection tape feels heavy. Translation. Market needs time to digest positioning. Regime 3. Grind range reset. What has to be true? Leverage cleaned out fundamentals remain constructive, both sides reset risk. What it looks like? Sideways chop, volatility declines, support, resistance forms cleanly. Translation, base building before the next leg. Your job is not to be right today. Your job is to not get emotionally farmed. The 48-hour checklist. Do this instead of panic. Here's your checklist. If you're stressed, turn off the chart, not because ignore reality, because staring at volatility doesn't improve your decisions. Check these instead. CME margin notices, risk changes, rules changed once can change again. Open interest changes, liquidation versus fresh shorts. Warehouse stock updates, is metal leaving? Physical premiums, is street price holding? Delivery notices as we approach key dates. If physical stays tight while paper price is weak, you are watching a transfer. If physical collapses and inventories swell, then you reassess. That's how you stay sane. That's how you stay dangerous. This crash was designed to do one thing: make you question yourself, make you surrender your position at the worst possible moment, make you hand the medal to the people who can survive margin, survive volatility, survive the game. Whether or not the JPM trapped Deutsche story is literally true, the mechanism is real. The weak get shaken out, the strong absorb, and the tape looks like betrayal right before it looks like a launch. So here's the final verdict. If you're leveraged, get unleveraged. If you're not leveraged, get unemotional. And if you want to know whether this was a true delivery nightmare, don't guess, don't cope. Track the data, because the market lies in candles, but it tells the truth in inventory. Hold the line.